You're a seasoned investor, a small business owner, or someone who noticed the price of their morning coffee keeps inching up. Understanding financial news might just be the most valuable skill you develop this year. Think about it. Every headline you see about interest rate hikes, GDP contractions, or record-breaking market rallies is quietly shaping your life. They're determining everything from the cost of groceries at your local store to the value of your investment, saving, and even whether that dream vacation feels affordable or out of reach. The problem? Financial news often feel like it's written in a secret code only Wall Street insiders can crack. But here's the truth. Understanding it isn't just possible, it's empowering. Hi, I'm James Lin from Stewardship Finance Academy, where we break down complex financial topics into that are simple, relatable, and most importantly, actionable. By the end of this video, you will not only be able to decode financial reports and market trends, but you'll also have actionable tips to make smarter decisions about your money. Whether it's planning your next investment, creating a budget, or understanding inflation's impact on your wallet, I guarantee you'll walk away ready to take control of your financial future. Before diving deeper into today's topic, I've got an exciting announcement. If you are eager to take control of a financial future, don't miss out our free SFA Stock Investment Masterclass. It's a limited time offer designed to teach you valuable strategies to earn significant returns with just 15 minutes a day. But hurry, this opportunity is available for a limited time and we might remove it soon. Sign up now. The link is in the pinned comment and in the description below. Alright, let me ask you a question. Have you ever felt like financial news is purposefully designed to confuse you? If so, you're not alone. The terms like ASX 200 or bond yields can make it seem like you're staring at hieroglyphics. But here's the good news. Beneath the intimidating jargon are concepts that are actually quite simple once you understand them. Take the S&P 500 for example. It's just an index, a way to track the performance of the 500 largest companies listed on the US stock exchange. Think of it as a collective report card for these businesses. If the S&P 500 is up, it's usually a sign of market confidence. If it's down, it might reflect broader economic uncertainty. The point is, financial news isn't impossible to understand. Once you break it down, you'll realize it's not some insider language. It's an open book that everyone can learn to read. So why bother? Why should you care about financial news at all? Because it impacts you, whether you realize it or not. It helps you to make informed decisions, whether you're investing, refinancing your mortgage, or deciding on a career move. A basic grasp of market trends give you an edge. It gives you real-time insight into economy. Think of financial news as a pulse check for the broader economy. Inflation, interest rate changes, these are the forces that shaping everyday costs like gas, groceries, and housing. It empowers you to spot opportunities and avoid pitfalls. In the world where markets shift and industry evolve, understanding financial news can help you stay ahead, turning uncertainty into opportunity. And you're finding this breakdown valuable, don't forget to hit the bell notification so you won't miss any updates. We'll continue exploring topics like this in future videos to help you decode the financial world. Let me tell you a story about Warren Buffett, one of the most successful investors of all time. This story perfectly illustrates how understanding financial news can help you make life-changing decisions. It was 1973 and the Washington Post company was in serious trouble. Its stock price had fallen to just $20 per share amid a storm of negative headlines and panic among investors. While most people were selling in fear, Warren Buffett saw something different. Why? Because he didn't just read the headlines, he read between the lines. By analyzing the company's financial fundamentals, Warren Buffett realized that Washington Post was significantly undervalued. In his eyes, its real worth was closer to $400 a share. While others saw chaos, he saw opportunity. So what did he do? He invested $10 million, a bold move at the time. And guess what? The stock price dropped even further after his investment, falling to $10 per share. On paper, he had lost half his money. Most people would have panicked and sold everything. But not Warren Buffett. He stayed calm because he knew the company's true value had changed. Over the next few decades, his patience paid off in tremendous way. By the year 2000, Warren Buffett's 10 million investment in the Washington Post was worth over $1 billion. The moral of the story? Warren Buffett's success wasn't about luck, it was about financial literacy. He understood how to analyze financial news and connect it to long-term trends. And this skill turned what looked like a disaster into one of the most profitable investments of his career. The best part, you don't have to be Warren Buffett to apply this principle. With the right mindset and tools, anyone can use financial news to their advantage. Speaking of life-changing strategies, if you're inspired by Warren Buffett's approach, now is the perfect time to enroll in our free SFA Stock Investment Masterclass. This limited time offer will teach you how to make smarter investment decisions, helping you relight your financial story. Sign up now using the link in the description or pinned comment before it's gone. If financial news feel overwhelming, it's because we often lack the foundational concepts to make sense of it. But don't worry, I'm going to walk you through the basics. Let's start with one of the most important indicators, Gross Domestic Product, GDP. So what is GDP? Think of your country as a pizza company. GDP measures the total value of all the goods and services or pizzas produced in a given year. Every pizza sold represents economic activity. So by adding them up, GDP gives us a company's, or in this case, the country overall health. If GDP is shrinking, it signals a slowdown, which can lead to job losses and reduced spending. But there are two types of GDP, real and nominal GDP. Let's stick with our pizza analogy. Imagine in year 1, your pizza company sells 50,000 pizzas at $10 each, earning $500,000 in total revenue. By year 2, great news, the company's revenue jumps to $900,000. But before celebrating, let's ask, did the company really grow that much? Or did prices just go up? On the surface, it looked like an 80% growth in revenue, called nominal GDP. But when we adjust for the increase in pizza inflation, the actual growth in the number of pizzas sold is just 20%. Real GDP is what truly matters because it shows the economy's true growth, not just the effect of rising prices. So what is GDP's impact on financial markets? Now let's imagine that your pizza company is listed on a small stock exchange. What happens when GDP or pizza demand grows? For the stock market, investors get excited about growth. They start buying more shares of the pizza co, driving up the stock price. For the bond market, strong GDP growth can sometimes lead to inflation. To counteract this, central banks might raise interest rates. Higher interest rates make borrowing more expensive for your pizza company, potentially lowering its profit and stock value. For the currency market, if your pizza company is part of the booming economy, foreign investors might want a piece of the action, strengthening your country's currency. While GDP is useful, it doesn't tell the whole story. For example, income inequality. GDP doesn't reflect how wealth is distributed. Quality of life. Are people better off, or is growth coming at a cost? Environmental impact. GDP doesn't account for sustainability. This is just one piece of the puzzle. If this breakdown is helping you understand complex concepts, hit the like button to save this video for future reference. That way, you can come back to it anytime you need a refresher. Inflation is one of those words we hear all the time, but what does it actually mean? Let me make it simple. Inflation is a gradual increase in prices over time. Think of it as the shrinking power of your money. The $5 you spent on a coffee last year might only get you half of one today. But what causes inflation? And why does it matter to you? It can be caused by several factors. Number 1, demand pull inflation. Imagine everyone suddenly craves for pizza, but there aren't enough pizzas to go around. The increased demand pushes the prices up. Number 2, cost push inflation. Now, let's say the cost of cheese skyrockets. Pizza chains raise their prices to cover the higher costs. Number 3, monetary policy. When central banks flood the economy with money by lowering interest rate or increasing the money supply, it can lead to inflation because more cash is chasing the same goods. Number 4, supply chain issue, like those we have seen during COVID-19 pandemic, can create shortages, pushing prices higher. Let's make this concept more relatable with a story about, you guessed it, pizza. In year 1, you buy a large pizza for $20. It comes with 8 slices. Each slice costs $250. Life is good. In year 2, the pizza still costs $20, but now it only has 7 slices. Each slice is $2.86. This is what economics call shrinkflation. You are paying the same price but getting less. In year 3, the pizza now costs $22 and it still has 7 slices. Each slice costs $3.14. Your money is losing purchasing power. It doesn't stretch as far as it used to. By year 5, the pizza costs $25 and has only 6 slices. Each slice now costs a whopping $4.70. Suddenly, your Friday night tradition feels like more like a luxury than a treat. So this is inflation in action. Your dollars buy less and less over time. Inflation isn't just a theoretical concept. It directly affects your everyday life. Inflation erodes purchasing power. The same paycheck doesn't go as far as when the price rises. Inflation hurts fixed incomes. Retirees or anyone relies on fixed pensions feel the squeeze as prices climb. Inflation impacts investments. If your savings or bond returns don't outpace inflation, you're actually losing money. Inflation creates uncertainty. High inflation makes businesses and consumers hesitant to spend, which can slow economic growth. Here's the thing, inflation isn't always bad. A healthy level of inflation, about 2% annually, is actually a sign of growing economy. It encourages spending and investment because holding on to cash becomes less attractive over time. But when inflation gets too high, it creates chaos. Take the 1970s for example. Inflation in the US shot to 14.5%. Prices spiral out of control, eroding saving and stalling economic growth. A phenomenon called stagflation. On the flip side, inflation that's too low can be equally damaging. If price barely rise, people may delay purchasing, slowing down the economy. Inflation might feel like an invisible tax, but there are ways to fight back. There are a few investments you may consider. Number 1. Invest in inflation-protected assets. Treasury inflation-protected securities adjust their value with inflation, ensuring your returns stay ahead of price increases. Number 2. Look for real estate. Property values and rental income often rise with inflation, making real estate a reliable hedge. Number 3. Diversify with commodities. Gold, oil, and other raw materials tend to hold their value during periods of high inflation. Number 4. Focus on stocks with pricing power. Companies that can pass increased costs to consumers, like utility or consumer goods, often thrive in inflationary environments. And if you'd like to go deeper into your financial education journey, download our free SFA investment tool list. It's packed with useful resources, from stock screening tools to portfolio management apps. You'll find the link in the description below. Inflation is a natural part of growing economy, but it's a balancing act. Moderate inflation can drive growth, but high inflation can erode wealth and destabilize markets. The key is staying informed and proactive. By understanding what causes inflation and how it impacts your finances, you can make smarter decisions to protect your purchasing power. From inflation often lead to a discussion on interest rates, one of the most powerful tools governments use to tame inflation. They are like an invisible hand pulling the strings of the entire economy. From the cost of your mortgage to the returns on your saving account, these rates influence nearly every financial decision you make. But what exactly are interest rates and why do they matter so much? So let's make it simple with a relatable analogy, the seesaw. Imagine a seesaw on the playground. On one side are the borrowers, people and businesses looking to take out loans. On the other side are the savers, who put money in banks hoping to earn a return on their savings. Imagine scene 1, the balanced seesaw. When interest rates are stable, the seesaw is balanced. Borrowers can afford loans and savers earn a decent return. Imagine scene 2, the tilted seesaw. Sometimes borrowers are borrowing too much and spending recklessly. To slow things down, the central bank, acting like a playground monitor, raises interest rates, tilting the seesaw towards the savers. Imagine scene 3, high interest rates. Now that the seesaw is tilted, borrowers find loans more expensive, spending slow, and businesses feel the pinch. Meanwhile, savers enjoy higher returns on their deposits. Scene 4, economic slowdown. With borrowers pulling back, economic growth slow. Realizing this, the playground monitor lowers interest rates to tilt the seesaw back towards the borrower, encouraging more spending and growth. Interest rates ripple through every corner of the economy. Interest rates affect borrowing costs. Higher rates make mortgage, car loans, credit card debt more expensive. Lower rates make borrowing cheaper. Interest rates affect saving and investment. High rates mean better returns on saving accounts and bonds. Low rates push people toward riskier investment like stock. Interest rates affect economic growth. Lowest rates stimulate growth, while highest rates slow things down to curb inflation. When rates are low, Refinance loans. Those rates mean you can reduce monthly payments or pay off debt faster. Consider major purchases. It may be a good time to buy a home or a car if borrowing is cheap. Invest in growth assets. Low rates often boost stock markets, making equities an attractive option. When rates are high, pay off high interest debt. Focus on eliminating credit card debt and other expensive loans. Take advantage of savings rates. High rates mean better return on saving accounts and certificate of deposits. Diversify investments. Bonds and dividend-paying stocks can offer stability and income during high-rate periods. Interest rates are the economy lever, balancing growth and inflation. By understanding how they work, you can make smarter choices, whether it's refinancing a loan or adjusting your investment portfolio. The seesaw of money may tilt back and forth, but with the right strategies, you can avoid getting stuck too high or too low. That leads us to fiscal policy. If you're enjoying content like this, make sure to subscribe to the channel so that you won't miss future videos. We cover topics just like this to help you make informed financial decisions. Fiscal policy might sound complicated, but at its core, it's something we all deal with, managing a budget. Just like families adjust their spending based on the income and expenses, governments use fiscal policy to steer the economy. They increase spending and cut taxes to boost growth during the tough times, or reduce spending and raises taxes to cool things down when the economy overheats. Think of fiscal policy as your household budget. Imagine your fridge breakdowns and you spend extra to replace it. It's like a government increasing spending to stimulate growth. Now, if you've been overspending and need to save for a future, you might cut back on eating out. That's like the government raising taxes or reducing public spending. Governments use fiscal policy to influence the economy through two main levers. Number one, the government spending, which affects the infrastructure building, public services funding, or financial aid provisions. Number two, taxation, which involves adjusting income tax, corporate tax, or sales tax to either leave more money in the people's pockets or collect more for public use. Some people confuse fiscal policy with monetary policy. To understand fiscal policy better, let's compare it to monetary policy. Fiscal policy is managed by government that focuses on stimulating demand or cool the economy with government spending and taxation. Monetary policy is managed by the central bank that focuses on controlling inflation and stabilizing currency with interest rate and money supply. Both are essential, but they serve different purposes. Fiscal policy is more targeted but slower to implement, while monetary policy is quicker but more indirect. During the 2008 financial crisis, the global economy was in free fall. Banks were collapsing, unemployment was soaring, and fears was everywhere. The US government responded with expansionary fiscal policy in the form of the American Recovery and Reinvestment Act and $831 billion stimulus package. It funded infrastructure projects, renewable energy, education, healthcare, and unemployment benefits. The results are that the massive investment creates jobs, boosted consumer spending, and help the economic recovery. This is a textbook example of how governments can use fiscal policy to pull the economy out of the recession. Fiscal policy doesn't just stop at government spending, it creates ripple effects throughout the economy. Economists call this the multiplier effect. Here how it works. Let's say the government spent $100 million to build a new bridge. The construction companies hire workers. Those workers spend their wages at local businesses. Local businesses in return order more goods and hire more staff. The initial $100 million investment ends up creating far more than $100 million in economic activity. That's the power of fiscal policy when it's used effectively. While fiscal policy is powerful, it's not without its challenges. High level of government borrowing can strain future budgets and lead to long-term debt issues. When governments borrow heavily, they can drive up interest rates, making it harder for businesses and individuals to borrow. Fiscal policy takes time to implement. By the time the effects are felt, the economic situation might have already shifted. Fiscal policy isn't just a macroeconomic concept. It affects your daily life in tangible ways. Tax cuts means more money in your pocket, while tax hikes reduce disposable income. Increased government spending can improve infrastructure, healthcare, and education. Fiscal policy influences inflation, which impacts everything from grocery to mortgage rates. Fiscal policy at its heart is about balance. Spend too much and you reach long-term debt. Spend too little and you risk a stagnant economy. Governments must walk a fine line to keep the economy stable and growing. When you hear about government spending or tax cuts in the news, remember it's part of a larger strategy to manage the economy, just like balancing your household budget. If you know someone who can benefit from this information, share this video with them. Sharing is a great way to help others take control of their financial future too. The world of financial news can feel like an endless ocean. Waves of data crashing from every direction, with some currents pulling you towards the panic and others towards opportunities. But here's the secret: you don't need to understand everything. You just need the right strategies to filter out the noises and focus on what matters most to you. Here are 5 actionable tips to help you navigate financial news like a pro. Number 1. Start with reliable resources. Think of reliable resources like Lighthouse. They guide you through fogs of misinformation. Stick to trusted platforms like Bloomberg, known for real-time updates and detailed market analysis. The Wall Street Journal, in-depth reporting on market trends and policies. Reuters, credible, fast, and globally respected. CNBC, quick insight into business and stock markets. Number 2, cross-reference information. Relying on a single source is like having one compass reading. It might lead you astray. Cross-referencing multiple outlets ensure you're getting the complete picture free of bias. For example, if reports a company stock is searching, check Wall Street Journal or Reuters for further context. Is it driven by strong fundamentals or just a short-term hypes? Number 3, use technology to stay informed. Leverage tools like Google Alerts or apps like Yahoo Finance to track specific companies, industry, or keywords. Set out notifications for topics like Federal Reserve interest rates or AI stocks, so you're always in the loop without being overwhelmed. Number 4, develop critical thinking. Ask yourself questions like, what's the biggest trend behind this news? How does this information align with your financial goals? Is this a short-term fluctuations or part of a long-term shift? Volatility is part of the marketing. Don't let sensational headlines drive emotional decisions. Focus on fundamentals and your long-term strategy. Interpreting financial news isn't about reading every headline. It's about understanding the bigger picture. With the right tools, critical thinking, and a calm approach, you can turn information into actionable insights. Before we wrap up, let me remind you about the free SFA Stock Investment Masterclass. This limited time offer is your chance to learn actionable strategies for earning significant returns with just 15 minutes a day. Sign up now using the link in the pinned comment or description before it's too late. Congratulations, you make it to the end of this guide. If you're feeling a little overwhelmed, that's okay. Financial literacy is a journey, not a sprint. Thank you for watching. If you're ready to make a change, don't wait. Sign up for our free SFA Stock Investment Masterclass today. See you in the next video.